So tell me what we're seeing here.
Yeah, so on the left we have the S&P 500, and you
Mm-hmm.
can see the green box and the red box. These are the ranges that are pretty much, they define trend, and you really can't get too bearish unless you get below the green box, or too
Mm-hmm.
bullish unless you get above the red box. And so even the Nasdaq's not above its own red box. It's not featured here, but it's still below there. And the picture on the right is the value line geometric average, and that's an equally weighted index that has about I guess it's about 1,500 stocks in it. And what you can see is during the decline from last year, they pretty much moved in lockstep with each other, right up until the moment the banking crisis actually started. So the banking crisis started on March 7th. So if we measure everything from March 6th, we can see that both the value line average and the S&P went down into the green box as a result of the
Right.
banking crisis. But if all you're looking at is the S&P 500, you can now see that we're now back to overbought, and it looks like not only are we overbought, but we're actually above where we were the day before Silicon Valley went bust. So it looks like we dodged the banking crisis bullet, which would be, if you're looking at this alone, that would be a fair assessment.
Mm-hmm.
But if you look at the value line average, which is again equally weighted in telling you what the average stock is doing, we're still oversold. We're nowhere near above where we were before the banking crisis started. And actually, if you look at what's actually happened since the 6th of March, there's only 3 sectors that are up on average. And I think I could probably win a bet in a bar if I ask this question, but unfortunately, the 3 sectors are utilities, healthcare, and staples.
Yep.
Everything else, and I stress everything else, including tech, the average tech stock is below its March 6th low. And what's even worse is if you look at the market there, the S&P, it bottomed on March 13th.
Mm-hmm.
Since the market bottomed on March 13th and ran all the way across the range, it got back to overbought. Since that bottom, the average bank stock has dropped an additional 15%.
Wow.
Mm-hmm.
So that's what's going on beneath the surface. And it's critical to realize that none of this means that what's working won't continue to work. I mean, we saw from 1998 to 2000, that was that stealth bull market.
Yep.
That was the old economy versus new economy. Maybe the bull market going forward will be all driven by AI related stocks. It's possible. You have to keep an open mind. But what it is saying is that in this environment, it's not just the opportunity set's not just long. There's still shorts to be had.
Mm-hmm.
And unfortunately there's a lot of them. And as I said, the average tech stock is down about almost 6% since March 6th.
Yeah. And I feel like in a normal environment, you kind of have these more in line with each other. This divergence is not the norm. I mean, certainly, ideally, when things are going up, it's kind of like everything's going up, and it's a lot more forgiving because yeah, I'm doing good, but everything's doing good. It's kind of like you don't have to be a genius to pick a stock. Darts do a pretty good job, but in this market, I mean, I guess it's that classic line of stock pickers market, because if you're not in the right stocks, you're not having a good time.
Yeah, there's it's always a stock pickers market. Even in a bull market, it's still a stock pickers market, because that's actually, to me, if you ask me, if the S&P continues higher, driven by a handful of stocks, and everything stays down, everything else stays lower, that's a pretty easy market, because you know exactly what to buy. I mean, it's like buy these 20 stocks. But if we actually go into a robust bull market, that's actually harder.
Mm-hmm. I mean, you're almost a kid in a candy store at that point, right? Because you're like everything's going up, and like, how to figure out? That doesn't make a lot of sense. I mean, it's almost it's funny because it almost seems like both. It just depends. Like if you are in these AI stocks, you have every right to be bullish, right? Even though it's a narrow type of market. But if you're bearish because you see all these other stocks collapsing, it's like it's an environment where you can have both parties right. It doesn't have to be either or in this case.
Yeah, it's actually the quote on this page from my website says this condition reminds me of F. Scott Fitzgerald's quote: "The test of the first-rate intelligence is the ability to hold 2 opposed ideas in the mind at the same time and still retain the ability to function." Right. That's what this is all about. And so you can puzzle about it, you can be confused about it, and that's all fine. And I'm not saying that that's a bad thing. But at the end of the day, if you actually just kind of step back, what it's actually saying is, if this is trend following, well, we follow trends. Well, where are the trends? Well, they happen to be in both directions. Well,
Right.
what should you do? Well, you should do both. It's a hedge fund after all. But I will say this too, though, that the rally that happened off the October bottom was, as I said earlier, was distinctly different, importantly different from what happened during all the other rallies during 2022, indicating that whatever the market was concerned about during 2022, the lows in October fully discounted it, and the market was looking forward and it liked what it saw. So with that being a backdrop, in the fact that the market was down about 25%, whenever the market's down 25%, you do one of two things from there. You either bottom, base out, and then go into your next cyclical bull market, or you go down another 20% in a crisis mode. So what we've had so far up till now has been a cyclical bear market. I wouldn't deem this as being a crisis bear market like 2008, 2009, that kind of thing. So whenever we get this far down in the market, I'm always looking for short ideas, but I'm also mindful of the idea that we're probably close to done. Right. And the fact that we had the magnitude and quality of rally that we had last year off the lows tells me that the market was looking forward and it likes what it sees. Since then, of course, we've had this banking crisis, and as you can see, both indices are holding above support, despite the fact, think about this, despite the fact that the 3 of the 4 largest bank failures in U.S. history have happened in the last couple months, and we're still above support. You can't ignore that, right? So put all that together, and what do I think? I think we're probably going to bottom. I think my risk gauges are probably going to inflect higher, and I'm probably going to cover all my shorts, and I'm just probably going to gross up my long book. But I'm not really in the forecasting business. I'm in the reacting business, and right now I don't have anything to react to from what I currently have on.
Let's talk about this a little bit more in terms of this forward-looking kind of idea that the market does, and this is kind of the whole concept behind trend following, is that we want to be on the right side of that, and sometimes it does require patience, because just because you bottomed, as you said, doesn't mean you're going up immediately. You could be basing out, and we've seen that a number of times. The bottom, there's the V-shaped bottoms, which they act one way, but then there's the bottoms that happen and you kind of drag on for a little bit before you really start going. So maybe you could talk a little bit about the mindset that you have to have in order to remain patient during those times.
Yeah, I think this is a critical concept. And when at our last CMT symposium, I had the great opportunity and fortune to interview Jerry Parker, who's one of the few turtle traders who came out of that whole experiment, with a great track record. And the whole point was that I could have had him on the stage in front of a bunch of CMTs, 350 technically minded investors, and asked him questions about his process, and does he buy the 200-day breakout or the 213-day breakout, just to try to get the edge on what he does. But the truth of the matter is that none of that, it's like you can't make money unless the process works. But just because you have a good process doesn't mean you're going to be able to make money. And his experience is case in point. He was, back in the early 80s, he was one of 20 turtles. They were all taught the same exact breakout system, risk management. They all traded the same instruments. They traded in the same office. And they were all taught by the same exact legend of trend following. So if there ever was a situation where you were going to have a tailwind to start your career in trend following, go on over the next 40 years and crush it, that was it. But how come nobody asks, well, if that's true, then why did only 3 or so turtles actually do really well? I mean, if it's just signal and if it's just risk management, it's not just that. It's mindset. And when you talk to Jerry Parker, it's his mindset is what kind of carries him through these difficult times. And we're in one right now. And you hear a lot of people today talking about how, quote unquote, trend following is not working. And I think that's just half right. That, what is trend following? Trend following is a process that gets you on the right side of major trends. It does really well in that environment, but it also does a great job of identifying bad environments and protecting your capital. So is trend following not working over the past year? I'd say it's working great. It's doing a great job doing the other half of what you signed up for, which is protecting capital. So right. The idea is, dig small holes when you're just in an environment that's not, ripe for, right tail events. But always, as I said earlier, even though we're in a bear market, I'm always upgrading the portfolio and making sure that I'm owning those horses that look like they're most eager to get this race started. And then when the bull market starts, which I'll be able to identify with the inflection in these risk gauges, I'll just gross up my book. But until then, I have in my mindset, as I said earlier, these inviolable rules of trend following. If I'm anxious about wanting to buy a stock, like Riot is a stock that looks like it's trying to come back again. There's a whole bunch of other ones that look like they're trying to come back again. If I'm anxious about trying to buy a stock like that, and I think it can go to 50, but it's at 10, it can't possibly go to 50 unless it goes above 11. So let's just find those levels that matter. And below there, don't be anxious. Just let trend following do what it does. Protect your capital until it's time to, put your capital at risk. And that's all mindset. It's be patient and just let the process work.
Yeah, I mean, it sounds like you're truly listening to the market, right?
Yes.
You're trying to keep that open mind and waiting and not predicting, which is, I mean, and it makes a lot of sense that when Jerry Parker, when you interviewed him, that only 3 of the 20 were able to make big money because human nature messes everyone up, and from following that plan, right?
Yeah, I mean, the market has a funny way of taking down even the best and brightest. I mean, look at long-term capital management, not everything else. So, if active managers, it's about 89% of active managers underperform doing fundamental analysis. And we can go back in history and isolate many fundamental analysts and portfolio managers who have done great. So is it the fact that nobody does well? Is it because of the process, or is it something else? I'd say it's probably something else, and it's the baggage we bring to the table as investors that kind of gets in our way of executing a process that works.
Well, let's use this example that you just kind of came up with. You've got a stock, and it doesn't have to be Riot. It could be XYZ stock, the favorite stock of everyone. You think it's going to 50. Your indicators are kind of showing that, the trend and everything. But that there's this critical level. So do you think that it's that people are it's a $10 stock and you should be waiting until it gets to 11? Is it that too many people are buying it at 10 and not waiting, or are they maybe misidentifying where they should be buying it? What do you think is the biggest problem?
I think it starts with expectations. I think that people, when they buy a stock, they expect it to work. And that is so opposite of the truth of trend following. Over a full cycle, you're really, really good at this if half of your trades make money. And if you're in a bear market, you're probably doing really well if 30% make money, right? And you're doing even better in a bull market, 80%, 90% make money, and you think you're a genius, right? The reality is, like, I have a statistic here in front of me that again, if you take trend and you break it into 10 buckets, 5 to -5. 5 is a high momentum uptrend, and -5 is a high momentum downtrend. And then you can say, okay, well, if measuring from when each of these trends started, are they in the money or are they losing money, right? So if you're in a bull market, all those positive, it's basically 1 through 5, all those buckets will be in the money. They'll be up from the moment they inflected to positive trend. And if you're in a bull market, anything that's in a downtrend is probably going to be up as well. That's telling you that whatever's breaking down is not going down, right? That's the proverbial bear trap, et cetera. But if you look at the numbers today, first of all, 50% roughly on the weekly chart, 50% of the market's in a downtrend. So again, that's pretty much, let's not ignore that. But when you look at all of the uptrends across, the 1 through 5, 56% of them are in the money. 44% of those breakouts have failed. Right? Then when you do the same analysis on the downside, -1 through -5, 94% of the stocks that are in a downtrend have gone down since they broke the level that put them in a downtrend. Wow. That's a bear market.
Yeah.
So knowing all this, that helps you manage your expectations. So like today was a big up day. I didn't have a great day today. But I had a bunch of these really bad days in 2022, but I stuck to my guns. And when the market got overbought, the models didn't inflect. I just increased my short exposure. And so we're, right now it's, if you do this analysis on the quarterly chart, as I said, it's almost 60% of the market on the quarterly chart is in a downtrend. So if you get overbought in that context, that's an overbought long-term fundamentally driven downtrend. So that helps me build my expectations and put into context what happens day to day. So we were talking earlier about monitoring what happens with various buckets of trend. And if I look today, like the average quarterly time frame uptrend was up about 1% today. The average stock was up 190 bips today. So I can look at that and say, well, my longs weren't up anywhere near 190 bips today. So I had a terrible day. Something's wrong with my process, right? Expectations and mindset. But if I actually look and I see, all uptrends underperformed today.
Yeah.
And the downtrends were up anywhere from 200 to 250 bips today. Downtrend stuff we don't buy.
Right.
We're not even trying to buy that stuff, right? So if I know that all the gains came today from stuff in a downtrend, am I actually going to start thinking that trend following is not working? Or am I actually going to say, well, this is a downtrend? Volatility, by the way, is greatest when you're in a downtrend.
Yeah.
So it's all about perspective and really understanding truly deeply what you're doing and what it's going to get you to do, what has to happen in order to get you to do something different. And that's all based on these inviolable rules of trend following. And until they happen, you just have to keep perspective and keep the faith in that long-term process, if you will.
No, and there's a patience level. And you kind of made the reference earlier to the what we call the Bunker Hill strategy of not shooting until you see the whites in their eyes. And we were kind of talking about this as you were, discussing it and bringing it up. How scary must that be if you've got this whole host of things coming at you, which we do. We've had over the last year all sorts of news coming at us. Right now, it just so happens to be the debt ceiling, but there's certainly recession, inflation, all of these things. And you're supposed to be just sitting there waiting and not firing quite yet. So I guess, what do you rely on in order to give you that conviction of, hey, waiting is going to be the best thing for me?
The process. Like I always remind myself that what I'm doing is based on these inviolable rules of trend following. Like good things can't happen unless these things inflect. 10 can't go to 50 unless you get above 11. It's like that across five measurements on 4 time frames. So good things can't happen until these things inflect. But when you think about that wait, don't fire until you see the whites of their eyes, you can imagine the anxiety and the fear they must have felt. Putting to shame any anxiety or fear we feel today, FOMO or whatever as a trend follower. But, so you ask yourself, like, what was it that probably gave them the courage to do that? They have a loaded gun. Hopefully it works. This is back in the Revolutionary War. So it's a loaded gun, but they had very little ammunition and they're waiting until they can literally see the whites of their eyes before they fire. What gave them the confidence to do that? I would say it had to be some combination of their respect for and confidence in Colonel Prescott, the guy that told them to hold their fire, and just a confidence in his long-term strategy of the reason he's doing this is because we don't have a lot of bullets. We have to wait for them to come upon us. So they just believed in what they were doing and they understood it, right? Same thing here. You have to have respect for the message of the market. I always say the market is the best fundamental analyst on the planet. That's why it's so hard to beat. So just listen to the market, right? Have a structured way to listen to the market, which is the process I'm describing. And then just have confidence that over time, trend following works. It doesn't just work. It's the best strategy over time. And I would actually tell you that anybody that's done well over time is either explicitly tells you they're a trend follower or they're implicitly a trend follower, because nobody makes money unless the price goes up. So it's all trend, right? So you just got to have belief that trend's going to come back again, but you'd have to have a structured way of identifying when it does come back. And then until then, hold your fire.
Yeah. And David, and really, I think to end this segment, just maybe a couple of quick comments on value stocks and how that strategy is in your opinion.
So this is a bit of a controversial statement, but I strongly believe that value doesn't work. And by that, I mean is that stocks don't go up just because they're cheap, right? So you can look at this chart here, and you can see that since the bear market started, value, this is just a ratio between value and growth. So value in the numerator, growth in the denominator. So when this line is going up, value is outperforming. And we all know this. Value has been outperforming since 2022, the beginning of the bear market, basically. And so we can look at this and say, undeniably, at least the way it's measured here, which is a whole other conversation, value's been outperforming. But what I always say is that value doesn't work. Like stocks don't go up just because they're cheap. They need a growth catalyst to unlock that that value opportunity. If there is no growth catalyst, then they just become value traps. And the opposite can be said of growth names too. Like William O'Neill has always said that valuation is not a good way to pick growth stocks, because growth stocks can keep going up even though they're quote unquote expensive. The reason they stop going up is not because they're expensive. They stop going up because the fundamentals inflect negative, right? So that's always what makes growth stocks go down and value stocks go up. So if you actually scroll down on this, Justin, on this page, what I did with this exercise here is I looked over the past year, this year in which value outperformed, and I just took the 1 year growth in revenues and I plotted that on the x-axis. And I took the 1 year change in price and I plotted that on the y-axis, and I created this scatter plot. And you can then create a best fit line, which is that red line. And if it's upward and sloping to the right, there's a positive correlation between top line revenue growth and price performance. So the top chart tells you that value is working, but I would say, as always, it's not value working. It's revenues are driving that inflection higher. And this shows that, revenues are always what matter.
Yeah.
Top line revenue growth, particularly over the long term, is what drives performance. And, as much as we can say value outperformed last year, it's still driven by revenue.